Gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors too is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can. And my whole point was, when the liars have to tell the truth, and when the liars are actually stacking gold at record levels, that's when you know there really is an uh-oh moment.
The investment landscape has witnessed a fundamental shift that challenges conventional wisdom about asset performance and portfolio construction. Matthew Piepenburg, a macro strategist at Von GREYERZ, focused on gold and global financial risk, has brought attention to a striking reality that many investors have overlooked regarding the precious metal's exceptional performance characteristics. Matthew Piepenburg points out that gold has actually outperformed the S&P 500 over the last 20 years, even when total returns with dividends are included. This remarkable achievement defies traditional investment doctrine and repositions gold from a mere defensive holding to a genuine wealth-building vehicle. The statistical evidence supporting gold's dominance is compelling and comprehensive. Gold has outperformed both stocks and bonds since the turn of the century, with SPDR Gold Shares rising 630% over the past 20 years, 85 percentage points higher than the SPDR S&P 500, which tracks major U.S. companies. This substantial performance margin demonstrates that gold has functioned as both a wealth preservation tool and a growth investment, challenging long-held beliefs about equity market superiority. Piepenburg adds that gold has also significantly outperformed the U.S. 10-year Treasuries and is currently the best-performing asset of the year, demonstrating its superiority across multiple asset classes. The precious metals evolution into the preeminent safe haven asset has accelerated dramatically in recent years. Gold has claimed the safe haven crown, establishing clear leadership among traditional protective assets. With spot prices surging 30% so far in 2025, bullion's gains are outpacing that of other traditional safe havens, such as the Japanese yen, Swiss franc, and U.S. Treasuries, compelling investors to rethink what true safety looks like in the face of fiscal sustainability concerns and looming wars. Gold's exceptional performance has been consistent across multiple market cycles and conditions. Gold was the best-performing asset in 2024, and so far again in 2025. Even despite fewer rate cuts than expected last year, gold was still the best-performing asset, demonstrating remarkable resilience in the face of less accommodative monetary policy. Before we begin, don't forget to subscribe, tap the bell icon, and share this video. Your support keeps the insights coming.
But in the case of gold itself, again, gold sits back during this whole string side of dishonesty. I talked to investors from Dallas to Davos. It's amazing what the registered advisory industrial complex or the wealth managers at the big banks, whether it's Pictet or Goldman Sachs or Morgan Stanley or JP Morgan or Bank of America, where you have to have high minimums just to get their advice. They all said, recently, until gold made the headlines, is, well, I was always told that gold was too volatile all these years. And yet, again, that's just a lie. Either it's really ignorant or really dishonest. And again, I'm not making these numbers up. Gold for the last 20 years has beaten the S&P on a total return, including dividends. So for 20 years, it's outperformed the S&P. It's certainly outperforming the sacred cow U.S. 10-year Treasury, the risk-free return, the haven. It's outperformed that dramatically. And again, it's the highest performing asset this year, which is why it's getting attention. But it shouldn't be because it's outperforming just this year. It's been outperforming for years. And yet we've had to apologize as gold bugs for being gloom and doom. And so the lie that's been told to many investors too is that gold is too volatile. And yet now central banks around the world, including the ECB, are trying to get as much as they can. And my whole point was, when the liars have to tell the truth, and when the liars are actually stacking gold at record levels, that's when you know there really is an uh-oh moment. It's certainly to understand gold. This is nothing new to us. We're not, even as Jeffrey Gundlach could confess, these gold guys aren't maniacs. They're not stackers. They're right. He just said it. So again, it's not about being a gold bug defendant or apologist or shill. these things are confirmed throughout history, certainly the last 2 decades. More importantly, the bond king himself, Jeremy Grantham, in the equities side, you look at Ray Dalio, the biggest hedge fund manager, Bridgewater. These guys are all talking about gold now with conviction. We've been talking about it for decades with conviction. So again, it's not a gold bug apology to tell the truth. And what I guess I meant by that article is gold has been telling the truth for a long, long time. It's been bailing out broken systems for decades, centuries, and millennia, from ancient Rome to the 90s in Yugoslavia, again to 1879 France, certainly the extreme examples of Weimar Germany. But governments always get over their skis in debt, and they always destroy their currency to monetize that debt. And as Hemingway said, debt creates temporary prosperity, ripping markets, tremendous wealth inequality, but it always ends in the permanent ruin of war and inflation. And what are the major concerns right now? The honest concerns about on anyone's mind is inflation and war. And there was a tweet that came out the other day: the debt keeps rising, the bombs keep falling. So it's not a coincidence that we're in this moment in history. Gold is reaching all-time highs again. Policies, and frankly, the sins of the power-hungry, short-sighted, myopic policymakers who only think one election cycle ahead rather than generations ahead, and have destroyed our currency in a slow frog boil since 1971 in obvious ways. And now all of that is becoming so obvious from signals in the bond market and elsewhere that the whole world is catching on. As we've always said, gold is not a momentum trade. It is a new form of money. It is real money, and it is a long-term investment, and it is there to ensure against the dying purchasing power of your fiat dollar. Nevertheless, it is encouraging to see flows into gold ETFs, but we've always said physical gold is the only way to go. It is interesting that the common man, if he can, and I respect how difficult it is to get an ounce of gold if you're worried about rent, mortgages, car payments, insurance, etc., in a very recessionary backdrop, which is only going to get worse rather than better. Of course, it's hard. But as Ian and I've tried to say, get as much as you can, as realistically as you can, bit by bit, time by time. We've been saying this for years. Now with the price, as you said, near 3,500, there's a race to really do that. You look at Harvard, again, I mentioned that because of Larry Summers. Harvard's endowment's over $50 billion, but they've had to issue bonds recently because they don't have liquidity, because most of their money is tied up into these credit pools, private credit pools, which are...
Europe's banking system harbors a massive systemic risk that could trigger widespread financial instability. Matthew Piepenburg, a macro strategist at von GREYERZ focused on gold and global financial risk, warns that Europe's financial system is deeply exposed through gold derivatives leveraged up to 100 to 1, far exceeding available physical gold. The numbers reveal the scale of this vulnerability. With over $1 trillion in exposure, the leverage ratio creates a dangerous imbalance between paper contracts and physical gold reserves. Even ECB economists now admit that paper contracts can't match real gold, posing serious systemic risk to the financial system. Official data confirms these concerns. The ECB reports that Eurozone banks hold around 1 trillion euros in gold derivative exposures, much of it traded over the counter with non-European counterparties. This structure places significant portions of the market outside traditional regulatory oversight, while creating complex webs of international counterparty risk. Let's get back to the video.
We've been talking for so many years and been called many things: gold bug, gold shills, perma bears, etc. Again, I've been very openly bullish on markets in 2020, 2024. I'm openly bearish on risk assets in 2025. So I'm not just a perma bear, but I'm very consistent on gold's long-term direction, and I have been for years, certainly since I started working with a mentor like Ian von GREYERZ and understanding gold over the last many years. But what prompted me to write this article today, or that came out today, wrote recently, as gold, the perfect lie detector, basically, for financial markets, is the reason gold is rising exponentially. Again, I don't know how many all-time highs we've had just in this year alone. It's the highest performing asset across the board in 2025. It's outperformed the S&P for 20 years on a total return basis. U.S. Treasuries are the worst performing asset over the last 5 years. They're down 50%. So this is not a gold bug, gold chill, sell your book, gold apology moment in history. And more importantly, gold has been very, very consistent for decades, frankly, for millennia, but throughout history. But as we hit this inflection point in 2025, there's so many strings we could pull on. But what prompted me to kind of just remind people of the dishonesty and how indestructibly honest, indestructible gold really is with some recent headlines, Elijah, that came out here in Europe, and they were on all the mainstream and yellow journalism. It was just everywhere in Switzerland and Germany and France, etc., that the ECB was making headlines because a group of economists at the ECB finally said the quiet part out loud, as I like to say. They couldn't, it's like a Freudian slip. They said gold could bring down the European system. Now, that's an extremely extravagant phrase. It made headlines, gold bringing down the EU, gold bringing down the economy. It wasn't that gold was doing anything than what it always does, which is hold its value, while paper money gets increasingly debased to monetize, frankly, criminally negligent monetary systems in the EU and the central bank at the ECB. And basically what this ECB economist report was is all the physical demand for gold is undermining the European system because there's been such a massive outflow, as you and I have been talking about over the years, certainly with COMEX, and Andy Schekman's been following this, and I've been following this, and you understand that these flows from the London to the New York exchanges, way beyond just bricks and de-dollarization, but this need for physical gold and not future contracts on the COMEX or the LBMA exchange. So in other words, countries want gold, but they're in all these derivative levered products, levered 100 to 1. And long story short, Europe doesn't have the gold or the money to meet its contracts. And they have over $1 trillion in derivative exposure to gold. Hence the headlines, could gold bring down the European system? It's extravagant. But what I'm basically saying is the European system, the central banks, the LBMA banks, the derivatives markets, all these weapons of mass destruction are finally being admitted to and confessed by even the economists at the ECB. And so basically what they're admitting to is it's a lie that paper contracts levered 100 to 1 do not equal an ounce of gold. In other words, they don't have the gold or the money, and they're caught in a major pickle because the counterparty to these European contracts is effectively Wall Street. And again, as things get more and more desperate, again, any string we pull, military issues, geopolitical issues, debt issues, bond issues, risk assets, stock issues, private equity, as things get more crazy, gold becomes more relevant as a conversation piece, as a store of value, and as a sane truth teller. And the truth is, once again, there was another open lie that derivatives and futures contracts and paper gold is not gold. And now there's $1 trillion uh-oh moment in Europe. And when that headline came out in the last week or so, it made me think, Elijah, of the broader theme of dishonesty, for which gold always kind of quietly bides its time and does its honest work.
Gold continues to prove its strength as a reliable store of value, especially in times of rising uncertainty and systemic stress. As financial institutions grapple with growing derivative exposure and increasing physical demand, gold quietly exposes the fragility beneath the surface. Its consistent outperformance, coupled with central banks' renewed accumulation, signals a deeper recognition of its role beyond speculation. In a world where trust in paper assets is fading, gold stands firm, not just as a hedge, but as a measure of truth in the financial system. Do you think gold will trigger the next financial reset? Will physical demand expose the truth behind paper contracts? Let us know in the comments. And don't forget to like, share, and subscribe for more insights. Thank you for watching, and we'll see you in the next video.